You hear a lot of stuff about the stock markets, how stock will build you wealth, etc. But there is one startling fact that you may not know, which is that since 2008, gold has given the same return as stocks. A recent presentation by Aditya Birla Sun Life Mutual Fund highlighted this fact. So what did they do? They compared the market cap of India since 2008 peak to its current value, and they also compared gold. So let's take an example, right? Ram and Sham both got 1 lakh from their mother in 2008. They both graduated in 2008, and Ram invested in the stock market, Sham invested in gold. Cut back to 2025, both have made the same return. It's astonishing, but they both made the same return. Now, a lot of people would say that this is playing around with data because we are using 2008 market peak. If you just move forward to 2009 to the market bottom, then actually stocks have given 50% more return than gold. And that is true. If you can pick the right points, data can change dramatically. But the point of this video is not to say that gold is better than stocks. Rather, it is to say that you should have multiple assets in your portfolio, including gold, including stocks, including debt, so that you don't depend on just one thing. All your eggs are not in just one basket. So just to reiterate the numbers on this, right? Since 2008, the USD return, the dollar return of the Indian market is just 6% CAGR, according to the same Aditya Birla presentation. In rupee terms, it is 11.5%. And in gold terms, that what if you had, what if the currency was gold, the return is flat. Why? Because gold itself has gone up so much, the same as the stock market. Now, in case you think that these numbers are too much biased by that particular point of time, you just have to look at the past year, right? The past 1 year, gold is up 37% and the Nifty is up 3.6%. If you only had stocks, just the Nifty, you would barely be at savings bank account rate, and many mid cap and small cap stocks have actually gone to negative territory. You would have actually lost money in that. 3 year as well, gold is up 18.5% and Nifty is 11.11%. So the skew has been so massive over the past year that even the 3 year return of gold is now beating the Nifty. 5 year, of course, they are very similar, 14.5 and 14.88. But the bigger lesson still stands. You should have a bit of both. Now, how do you do this? How do you have a bit of both? Earlier, sovereign gold bonds were really popular because you were getting the return of gold and you were getting some interest rate, which the government was paying, and the maturity value was tax free. But unfortunately, there have been no recent issues of sovereign gold bonds. So now your best, most efficient way of doing it is through gold ETFs or exchange traded funds. These are backed by physical gold. This is mandated by law. You don't have to worry about the exchange traded funds going bust. And it's a financial asset, so you can easily trade in and out of them or hold them for the long term. And so you can have a diversified portfolio.